Okay, good afternoon, everyone. Welcome to the 2024 Financial Literacy Conference. My name is Sarah O, and I'm a Senior Career Advisor at the USC Career Center. And we're so excited that you're here joining us today for the Investing 101 session. So before we get started, I wanted to share a few announcements. First, I want to thank our gold partners, Abbott, Enterprise, U.S. Marine Corps, Royal Industrial Solutions, Insight Global. And I also want to thank our silver partners, Aldi, Lisi Aerospace, Central Intelligence Agency, Cornerstone Research, eBischarge, Rakuten, U.S. Army Medical Group, and Wells Fargo. And another announcement that we have is our summer experience survey. So if you are a first, second, or third year returning in fall 2024, we want to encourage you all to take our SES survey. So whether you are traveling abroad or studying abroad, or if you have an internship lined up, or if you even don't have an internship lined up, we would love to know what you are up to. And especially if you don't have an internship lined up, we'd love to assist you in finding an internship and making sure that you have opportunities lined up to do something over the summer. And so please fill out the survey. And once you fill out the survey, you'll be entered into an opportunity drawing, which is going to give you a chance to win a $75 Amazon gift card. Now, we also have a survey for students who are graduating. So if you're in the class of 2024, we encourage you all to take the first destination survey. And for this one, we want to know what you're up to after graduation. So whether you're taking on a full-time role, what kind of full-time role you're taking on, in what company, as well as even if you're taking a short break, we would love to know what your future plans are. And so please fill out the survey. And once you fill out the survey, you also have a chance to be entered into a opportunity drawing, anywhere from $50 to $100. You can get a gift card, or you have a chance to win an Apple AirPods Pro. So I'm going to keep this here for about 5 seconds so that you can scan the QR code. Okay, I'm going to stop sharing now and let Mimi share her screen. And while she's doing that, I have the privilege of introducing Mimi. So Mimi began her wealth management career in Vancouver, Canada, at CIBC Wood Gutty Advising Domestic, International UHNW individuals on tax-efficient, traditional, and non-traditional investing. She then joined Aurochs Legacy Partners, where her responsibilities include reviewing portfolio strategies, reviewing ESG and impact strategies, and relationship management for notable families, foundations, and institutions. Mimi received her bachelor's in science from the University of Southern California, Marshall School of Business, and her MBA from the University of Toronto's Rotman School of Management. Mimi serves on Reaching Out NBA's Advisory Council and is the co-chair of the Rotman New York City Alumni Chapter. And for her contributions to the women and LGBTQ+ community, Mimi was recognized as a Forte and ROMBA Fellow. Mimi is a frequent speaker at conferences on topics ranging from portfolio management to community engagement, and she's a strong proponent of giving back to the community. Mimi's mentors students at the University of Southern California, and she enjoys pushing her limits and has run 3 international marathons. She's also originally from Taiwan, and she also lived in Vancouver, Los Angeles, Shanghai, and Toronto. Now she resides in Manhattan, Brewdog, Mocha. I hope I'm pronouncing that correctly, Mimi.
Mocha.
Mocha.
Well, thank you, Sarah, for that wonderful introduction. I just wanted to say hi to everyone. It's a pleasure being back at USC in a virtual format. I graduated from USC in 2012, so it's been a while, but have kept my best friends are still from USC, original dorm, New North. And it's a pleasure to be back, giving back to the community how I can. To Sarah's point, I mentor international students now, given my background where I've lived in Taiwan, Shanghai, LA, Toronto, and now New York, and wanted to discuss Investing 101 with everyone. My entire career has been in wealth management, and if you have any questions, please hold off on them until the Q&A session, which will start in about 30 minutes. So Investing 101, this is a part of the Rockefeller Global Family Office Next Gen Financial Education. It's something that I personally really believe in the sense that we should all learn how to best manage our assets, whether we are coming from generational wealth or whether you are the wealth builder. So when we think about financial education, there are 8 different components of it. There's personal finance, there's investing, there's planning for the future, there is wills, trusts, and estates, US tax basics, sustainability and impact, philanthropy, and entrepreneurship. I'll be diving a little deeper into investing, and in particular, Investing 101, which will really lay the fundamentals of investing. And then if you are interested, there is the Investing 201 tomorrow during the USC Financial Literacy Conference. And then if you just can't get enough, there is the Sustainability Conference on Thursday. So we have a packed week ahead of us, and each day I'll be building the roadblocks for you to understand investing from the fundamentals and then layering it on with a little more complexity and then going into a topic that has been more, there's been both the pros and cons in the media, but we'll dive into that a little bit deeper on Thursday in the sustainability and impact investing session. Investing 101. So to lay the foundation, we are looking at the very basics of investing. We'll take a step back. We'll look at the overview of 5 different areas. The idea of savings versus investing, what your investment goals are, what your risk tolerance is, going over the basic asset classes, and then finally, why we need to diversify a portfolio. When we're thinking about saving versus investing, you ideally want to be able to do both in tandem. For saving, what you're really focused on are goals within a year, particularly for the emergency fund. You want to be focused on building enough of an emergency fund where you will have 6 months to live off of should something dire happen. You know, no one can really predict life. Things happen, whether you decide to quit your job, whether you get laid off, which is unfortunate, or whether there is a natural disaster. You want to make sure that you have 6 months of fixed income or fixed expenses set aside for you to weather storms like that. When I'm talking about fixed expenses, we're thinking about rent, groceries, utilities, things that you really need to live your day-to-day. I'm not talking about that concert ticket that you probably want to buy, but shouldn't in this situation. But really, what are you going to need to be able to put a roof over your head and food on the table? For investing, we're really looking at goals that are over a year long. So when we're looking at the liquidity, typically for investing, it will take over a year. It'll take longer, typically 2 to 3 days to access the funds. When you're looking at alternatives, which we'll discuss not in this session, but perhaps in 201. When you're looking at alternatives, it'll take sometimes up to a quarter. There's often a couple-year period where you're not actually able, there's a hard lockup or a soft lockup of either a year to 2 where you're not able to pull from your invested capital. The risk of the investment bucket is that there is risk. It's the same old adage, without risk, there is no return, where if you're willing to take more risk, that's where you have the higher returns. And then with the earnings, as I mentioned before, the invested funds in a well-constructed portfolio, they have the potential for growth. So on the flip side, when you're looking at saving, think of vehicles like your savings account, your checking account, a money market fund. Those are all readily accessible, where it could take same day to liquidate the funds for you to use immediately. Cash is also considered as a quote unquote savings vehicle, but it is readily accessible the moment you need it. There is minimal risk associated with your savings account because you would have the FDIC insuring it. So, for example, when that First Republic situation happened, or when Silicon Bank collapsed, those funds were FDIC insured. As long as they're FDIC insured, you have 250,000 that you'll be able to have protected at that institution. Now, the earnings rate, the funds in your savings account can earn interest. In the current interest rate environment, you're seeing interest rates from 4 or 5%, which I'll explain that a little bit more in the investment asset classes section. But you're looking at 4 or 5% in earnings, which is quite high. So we're in a very great time period to be really taking less risk, yet receiving pretty high returns, moderate at least, moderate to high returns for a savings account. When we're looking at investment goals, and this will be personal to you in terms of what your goals and what your objectives are for any basket of assets. And I like to refer to this as the different baskets of assets, because then it's more easy for you to mentally bucket them in terms of, okay, can I touch this or can I not touch this? When you're looking at the short-term investment goals, you're really looking at what vacation do I want to go on this summer? If you want to start your own company in a couple months' time, if you have short-term goals for this basket, then you wouldn't want to take as much risk with this asset because you have a more immediate needs for it. Now, when you're looking at the medium-term investment goals, you're looking at maybe 5 to 10 years, and this could range anything from having a down payment for a house, childcare, tuition, expenses, big ticket items like that, that you'll really need to put off on touching so you can use it later on. And then long-term investment goals, we're really thinking about retirement. These are assets that we do not want to touch, that we want to use when we are 60 and want to live off the fruits of our labor. And to give you an example, so we have a client on the team that really likes to have these mental buckets. She has one that is for childcare expenses. We call it the education reserve. And that one has its own risk parameters because when we need to use it is going to be over 10 years because her kids are not yet at an age where she wants to tap into that education reserve. We're putting it away for college because college, as everyone at USC knows, can be quite expensive. Maybe you're looking at $80,000 a year over 4 years, and that is not including the other expenses, whether that's dining or graduate school down the road. So for this particular client, she has a basket or a bucket of assets that are strictly for that expense. But then she also has, on the other hand, another basket that is held for the long-term reserve, and it is named the long-term reserve fund. And with this one, it is over 10 years, it's over 20 years. It's a basket of assets that we don't want her to touch because the goal of it is to make sure that she can retire without having to worry about how to pay her bills. Next, when you're thinking about risk tolerance, and as I touched upon it a little earlier, you really have to think about what each basket of assets are used for. Now, the client that I referenced earlier, she's a little bit anxious, which is fine because, when you think about risk, it really is it's such a personal analysis where there is your ability to take on risk, but then there's also your attitude towards risk. So when I'm talking about ability to take on risk and your attitude towards risk, those are two different things that I would encourage you to also think about on top of what's being listed here, which is the timeline, age and lifestyle stage, portfolio size, and comfort level. So to break it down, we have the ability to take on risk, which is the timeline and the age and life stage. If you're on the younger side, then you have the ability to take on risk because you'll be investing for longer. If you don't have any imminent vacation goals or entrepreneurship goals, if you don't need to get that car or you don't need to buy that, put the down payment for your home, then you have a higher ability to take on risk. And likewise with portfolio size, if you have a larger portfolio size where, you're not going to lose the shirt off your back if we were to enter into recession, then your ability to take on risk would be higher. However, when you're thinking about your risk tolerance or your attitude towards risk, what you really want to think about is if you were to see a market downturn like we did at the height of COVID, market dropped 20, 30% in a single day, is that something that will keep you up at night? For some people it will, and for some people it won't. There is no right or wrong answer. It really comes down to the individual, and you want to anchor to the lower of the two, because even if you have an ability to take on higher risks, you want a moderately aggressive portfolio, but you'll be losing sleep, then there really is no point in investing in a portfolio that aggressive if every day you're checking your portfolio, seeing how it's doing, because it's giving you so much anxiety. So you really want to anchor towards the lower end of either your ability to take on risk or your attitude towards risk. And likewise, if you want to take on a lot of risk, but you'll literally not be able to pay rent if you lose your entire portfolio, then maybe you shouldn't be betting that much on the portfolio or with the portfolio. Next, we have asset classes. So these are three very general ideas of what asset classes are. And there is diversification within each of the asset classes where cash and cash equivalents, we're thinking commercial paper, actual cash, money market, they have high liquidity, looking at mutual funds, mutual funds. Then you have fixed income, which are debt instruments, bonds, and they're very income focused. And then the final one is equities, which is seen as ownership in companies, stocks, and they're much more growth focused. Now, within each of the asset classes, it goes further into how risky each subclass is. And within each asset class, why do we want to diversify? There is the age-old term, the saying that, you never want to put all of your eggs in one basket. For example, at the start of the year, I was taking a look at the indices from across the world. And it's a pretty comprehensive report. You're looking at what the S&P 500 did. You're looking at what the Russell 2000 did. You're looking at what FTSE, which is European markets, or you're looking at what emerging markets. You're really taking a snapshot in time of what their year-to-date performance is, what their one-year performance is. And what I was seeing was S&P 500 had a great year. At the start of the year, we were looking at 25, 26%. For the S&P. However, on the flip side, when we're looking at what was historically what a lot of people have been talking about as an emerging economic power, when you're looking at China stocks, China stocks were down, I want to say 35%. So even just taking a look at that, why don't we want to put all your eggs in one basket? Because if I invested everything in the emerging markets, I would not be doing well. However, if I only invested in the US, the flip situation could happen where the US could enter a recession and you would be heavily impacted by that one decision. So that is the main reason why we want to maintain a portfolio that is well diversified. Now, I'm talking about just within the equities. which I only use S&P 500 and, FTSE, China, Taiwan, other any of those indices as what you can potentially diversify within. However, even within the United States, even within the US market, you want to stay diversified too with small cap, mid cap, or the large cap. When we think about, for example, Amazon, why does Amazon sell multiple product lines? They sell multiple product lines because that is for them multiple ways to generate revenue. They're not putting all their eggs in one basket and only selling one item like toilet paper, but they'll also sell towels, bedding. Amazon literally sells everything. That's a very well diversified company. And then likewise with fixed income, you also want to diversify within the asset class. And typically when you look at a portfolio, you'll diversify amongst the equities and the fixed income and the cash. For a more conservative portfolio, you're looking at 40% equities, 60% fixed income, moderate, 50% equities, 50% fixed income, and aggressive, 75% equities, 25% fixed income. These are just templates for how you would construct a conservative to an aggressive portfolio. There are a lot more nuances that come with that, such as, like I mentioned before, your risk tolerance, your ability and your attitude towards risk. And all of that will play a factor into what the asset allocation of your portfolio is. Asset classes, so starting at the very basic level, we're looking at cash and cash equivalents. The primary advantage is the high liquidity. They're seen as lower risk with a lower return short-term options. And typically you'll earn interest on it, which is why for everyone on the webinar today, I would highly encourage you to double check to make sure that any of your cash that you're not readily using, that you don't have a plan for, that you're at least putting it into a savings account, and you're at least putting it into a money market account. Now, what do I mean when I'm talking about savings accounts or money market accounts? I'm not going to go into cash, because if you want me to go into cash, I can go into it in the Q&A. But when we're thinking about the savings accounts, we're really thinking high liquidity. The interest rate is going to be low. It's your typical, Chase savings account or Chase checking account. You're really not earning much there. Time horizon is short to medium term. You still are getting the FDIC insurance. And then money market funds, it's similar to the savings account. However, what we're seeing in the market right now, I'm seeing interest rates north of 5%, which, with not having to take on a lot of risk, minimal risk, if you're really thinking about the spectrum, that's a pretty great risk return trade-off. So your time horizon here is short and medium term. Again, it is FDIC insured. And then certificates of deposit would also be included in this box. However, the difference with the CDs is that you put it into a vehicle for a fixed term, let's say 2 years. For those 2 years, your interest rate is going to be 3%, for example. You will not be able to take out the money that you've locked into the CD, because that is by nature what a certificate of deposit is. You're leaving it there at the institution for 2 years at 3%. Now, if you wanted to withdraw funds, you certainly can do that, but there will be a penalty. Fixed income. What is a bond? When we're looking at bonds, we're really looking at any company, any government who's looking to raise money. So they want to provide a regular stream of income, and they'll also offer principal protection, with a slight caveat, because there's always a risk to everything. There is no free lunch in this world. Fixed income is seen as higher risk and higher return of an investment option compared to cash. Some of the risks that are associated with fixed income, you're looking at interest rate risk, reinvestment risk. and default risk. Interest rate risk, when we're thinking about interest rate risk, there's been a lot of talk about the Fed increasing or decreasing interest rates. That would impact the value of the bond because, say we have a bond, it pays you a 5% interest rate. If something with a 6% interest rate for the bond comes out, then I would not want the 5% interest rate bond because I want a higher regular stream of income and I would want to purchase the 6% interest rate bond. And which goes again into the reinvestment risk, which is if I can get the 6% interest rate bond, why would I want to purchase the 5% interest rate bond? So the value of the 5% interest rate bond will decrease relative to the 6% interest rate bond. And then default risk is really looking at the credit quality of a company. So for example, we're looking at Apple. If Apple doesn't, no one is really concerned about Apple defaulting. However, if we're looking at a startup, I'd be a lot more concerned because I'm not as sure about their income projections. Or if you want to take it into a more, day-to-day reference, think about investing in either a child or their parents. With the parents, you know that they have a regular stream of income. You're more than likely to get your investment back. However, if you were to invest in a child who's just starting off their first job, who doesn't quite understand saving yet, perhaps you'd be less willing to invest with them because you just don't have as much of a guarantee. So you can think about the risk in that way. So equities. Equities is on the most risky side of the spectrum that we alluded to earlier. And this is really thinking about ownership of a company or shares of a company, which translates to an ownership of a small percentage of the ownership of the company. They're issued by both public and private companies. Public companies are typically traded on the stock. I can go in and I can buy 100 shares of Apple. I would have 0.000000001% of Apple, but I would still own that 0.00001% of Apple. However, for private companies, they have shares too, but they would be sold in the secondary. And that is a completely different topic that we'll probably go into in a different session. For equity, you're really earning returns in two ways. You have the capital growth through the increase in share price or the dividends from the company. When you're thinking about capital growth, you're really thinking about, okay, I'm going to keep picking on Apple. Apple is doing great. Everyone loves the new Vision glasses, the new Vision Pro. Everyone wants to buy it. There's a lot of hype around it. And, we're buying it for everyone in the family. So you'll be seeing that capital growth because of the expectation of Apple coming out with better and better products. Maybe the iPhone 16 is incorporated in VR, but you get my point, where the capital growth will come from this company is doing really, really well. And we, the public, believe in this company, so we want to keep buying the shares of Apple. Now, the dividends would mean that Apple is seeing that everyone on this call, everyone in this webinar, we're all buying shares of Apple, and they want to reward the owners of Apple stock with income. So then you'll see them paying out distributions, they'll have dividends, and those are the two different ways of generating earnings from equities. And equities, as you can see, is a higher risk and higher return. Apple or Amazon, or I'm just listing some of the most stable companies. If we're thinking about, let's see, Tesla has been fluctuating quite a bit. So if we're seeing Tesla, higher risk, if you see the fluctuations of the stock price, That's because there is more risk embedded in how Tesla will do as a company, how Elon runs the company, and the volatility that you're seeing with the stock price, you won't see quite as often within fixed income. Mutual funds. So now we're really talking about the different vehicles of purchasing and of different structures within the markets that you can purchase assets from. Mutual funds are really, it's actively managed, which means that there's an investment professional, there's me sitting behind charts, me sitting behind the terminal, and we're really just analyzing and putting an investment philosophy behind what do we think is going to be the driver of growth for this fund. Maybe this fund is focused on small cap within the US. Maybe it's focused on emerging markets. Maybe it's focused on large cap growth, large cap value. But what it means is that there's a team of analysts and a portfolio manager really sitting behind the desk and picking the stocks that they think will outperform the market. Typically, and not mentioned here, but typically mutual funds, you're also looking at a higher fee percentage charge, but that's associated with the investment manager who's actively picking stocks for you. ETFs is another vehicle. So this vehicle is more of a passive role. I mentioned mutual funds in that there's a portfolio manager sitting there picking stocks for you, really analyzing the market, seeing what would outperform. Or there's the passive hold, which is an index tracker. So you're looking at S&P, any basket of securities. It's traded on the stock market as well. However, you don't have anyone sitting beside or behind the computer really analyzing each individual stock for you within the sector that they are managing. It's more so if I'm favorable upon the S&P 500, I'm just going to buy the whole index. You know, even if I don't like that one or two stock in the S&P 500, I'm just going to buy it because it's one more of a low cost way of purchasing into the market. And maybe you don't maybe you don't need to have a active manager sitting behind the market who's taking a look at that for you. And portfolio diversification, I know that we touched upon this a little earlier, but there are two different types of risk. There's the market risk, which is really known as systematic risk. This is risk that you cannot diversify away. So it's risk of the overall market, which comes with owning any asset. Companies within a market tend to relate to each other such that valuations move up or down. And this can be impacted by factors such as government policies, geopolitics, consumer preferences, natural disasters or wars. So like I said, again, these are things that you cannot control because we all know that there are certain things you really just can't control in life. The pandemic, wars, but you want to be mindful that as much as you want to diversify, and it's still really important to diversify, that there are just some risks that are part of the nature of investing that you just cannot diversify away. And then the second risk is the asset-specific risk, the idiosyncratic risk. These come from the investments or the companies themselves. So, you know, the company's products, management's performance, competitive landscape for that company. I was just listening to the market today where I'm picking on Tesla now. We're going to pick on Tesla. There are so many new entrants to the EV space. I just drove a recent Ford Mach-E. I never thought I'd drive a Ford or an EV, but now I love it. I'm not ever going to drive one in New York, but the point I'm trying to get at is that these are risks that would impact Tesla's performance because we have new competitors. Maybe people don't care as much about EV, or Elon's really just gone off the walls. These are all risks that are specific to the investments, which is why, along with Tesla, we also want to be investing in other asset classes and other companies. So I mentioned this earlier, within asset classes, there are ways to diversify. You have within the fixed income, a broad spectrum of US Treasury, munis, and corporate bonds. It's based on their credit quality. So when I made the reference earlier, you'll have the parents who you don't mind lending money to because that's essentially what a bond is. You're just lending money and then you're charging them an interest rate. I'm more than happy to lend $1,000, $2,000, $100,000 to the parents. However, for that kid who's 12 years old, maybe not so much. Maybe I charge him a higher interest rate because there's more risk associated with him or her. And the parents, I'm a little more relieved because I know that they have well-paying jobs. For maturity, longer-term bonds tend to receive higher returns because they are locking in that income stream for a longer time. Now, for equities, we have the different sectors. You're thinking maybe consumer products, technology, finance, tech. So those are all different sectors that have different risk parameters within themselves. Larger companies tend to be more stable, but also slower growing. And then there is also growth and value stocks. Technology would be more geared towards growth, and then something like finance would be more towards value. And then within both fixed income and equities, we're really looking geographic diversification. We want to invest in Europe, Latin America, emerging markets, so maybe Asia as well. And I'm just giving you the very high level geographic areas and not the underlying markets. And again, active versus passive management, whether we want someone to sit behind the desk and really pick those stocks for you, or whether you prefer the lower cost alternative, which is ETFs, where you hold a basket of assets. You buy and hold essentially. And that is the end of the presentation, and I think I am right on time. So I will open it up with Sarah's help to Q&A.
Amazing. Thank you, Mimi. All right, we will go into the Q&A, and there are several questions here that we will choose from. And so first question for you, Mimi. What is a good amount of money to start investing / start a portfolio with?
I've really seen it across all spectrums, in the sense that if I have a family that I'm working with and as part of their trust and estate strategy, they start giving out, you're able to give out like $18,000 every year, tax free, where you don't get the gift tax, except you don't get impacted by gift tax. They'll build out a portfolio for their younger children where it could start at, after 2-3 years, it'll be at 36,000, and that's what they use. But keeping that in mind that, the family is actually worth maybe $40 million. But it really, what I'm trying to get at is there is no right answer to it. It is what you're comfortable investing in. If you are investing your own assets and you're just testing it out, I would want to err on the lower end, just so you get more familiar with it. I was in a training class before where you can also do paper trades where, you don't actually put money into it, but you do your research on the stocks, you do your research on the mutual funds, ETFs, however vehicle you want to buy it in, and you record what the price is on that day. You track it yourself, and every week you see what the movement of the price is. And then within a quarter, you'll have your performance report to see if you actually had invested in that stock, how you would have performed. So it really depends on what your basket of assets that you were working with and what your risk tolerance is. don't invest something that would eventually be your down payment. Do not do that.
Yeah, great advice. Another question is, what is the easiest form of investment we should do now/tomorrow as our first step?
Well, I hope everyone has a retirement account, and if you don't tell me that. I would put that all into an S&P 500 ETF tracker.
Awesome. Okay. And then in your opinion, what are the best banks to open a high yield savings account with? Should students or alumni always focus on the one with the highest APY?
Um, I would take a look at it. It doesn't really matter the bank that you'd be opening it with, because from what it sounds like, you are focused predominantly on what the savings account return is. I wouldn't actually recommend savings accounts as ways to accumulate or to put your assets. It's listed as one of the cash and cash equivalents. However, you can also go to your brokerage or financial advisor, open an account with them, and then invest in a money market, where even if you wanted to do it online yourself in a self-directed account, you can do a money market fund, which would generate a higher interest than you would with any institutional account, like any savings and checkings institutional account.
Great, thank you. We also have several questions about stocks. So, a student or alumni is asking, how do you recommend someone with limited knowledge in stock investment to educate themselves to feel more comfortable in purchasing stocks? And do you recommend going to a financial advisor, a website, a bank? How much of this portfolio diversification and stock picking should be done by like regular people or students versus with an investment professional?
Well, I always take the approach that, even on our team, that there's an element of people come to us because of a multitude of reasons. One, maybe they don't know the markets as well. Maybe they don't have time to do the research, which is what we see a lot of times, oftentimes. But we also take, for those clients who are interested, more of an educational approach, where we want you to be well aware of what you're invested in, because it's important to know the risks and rewards of anything that you do, any path. So that's what we highly encourage on the team. And that's what we do with our clients. But in terms of whether you want to work with a financial professional or not, that's more of a personal decision. And it really boils down to how much time you have on your hands, how comfortable you are with it. I do think that, yeah, that's a pretty personal decision whether you want to engage with a financial professional.
Great. So next question is, how do you invest in emerging markets such as China, Taiwan, basically anything outside of US stock market?
Anything in emerging markets, there are a couple of different ways. Like I mentioned ETFs, and I also mentioned mutual funds. So both of those are different avenues to invest in emerging markets. There are ETFs that will hold all of emerging markets, and or if you want to isolate it to just like Hong Kong index or Taiwan index or China index, you can certainly do that as well.
Thank you. And then there's a question about a student who is in debt. Do you have any tips for those who have student loan debt? And it says a lot of it.
Student loan debt, I would I would verify what your interest rate is first, and really run the numbers on what the cost benefit of paying down your debt is, or investing the assets that you have. Now, remember that returns aren't guaranteed with any vehicle of investing, whether you're thinking about equities or fixed income. But there is that route where, for example, if you had a mortgage or any debt, and you're able to generate more returns than what your interest rate is. Sometimes it's actually more advantageous to hold on to the debt and not pay it off and invest instead. Now, this is a case by case basis, so I wouldn't encourage everyone to say, oh no, we're not going to pay off the student debt or credit card debt. Always pay off credit card debt. Oh no, we're not going to pay student debt. That is not what I'm saying, but it does come down to the interest rate, what your after tax return is, and um, how much you think you'll be earning.
All right. And then we have another question about high yield savings account. So if you want
Mhm.
to save to buy a house in 3 to 5 years, is it fine to put that money into a high yield savings account as opposed to investing it in securities?
In 3 to 5 years, I would put it into a lower risk portfolio. High yield savings account, because with a high yield savings account, depending on what the interest rate is, maybe that is 3, 4%. The thing with savings accounts is that the interest rate could change too. That's not forever. Our interest rate environment is not forever. So you do have to take into account, okay, if I'm planning to buy a house in 5 years, I want to be less risky with it, but can I stomach a little bit of risk because that's really where you're gonna get the growth from.
Right. And another question is, what percentage of all types of investments do you recommend for personal individuals with limited time to research stocks? So how much mutual funds, ETFs, stocks, bonds, etc.
Um, I So with mutual funds, you'll have a higher percentage when it comes to the fees that they charge. Um, I I'll speak on like you can use any of these vehicles. I think it really depends on how much you want to trust someone to just do the stock picking for you or not. Mutual funds are more expensive. Um, ETFs are a lot cheaper if you just want to like, okay, I just want to buy the S&P 500 and forget it and not do a lot of research. You can do that. Um, and likewise with mutual funds, as long as it's a big enough of a sector that you're working with. I would say that if you had very little time, then I would gear more towards ETFs than the mutual funds because with mutual funds, you do want to do some research in terms of what their investment philosophy is.
Great, thank you. And a student is asking, how do you decide on an investment account company? They all seem pretty fairly similar. Are there any red or green flags to look out for?
Investment account companies. Um, would you mind clarifying that one? Are we able to ask her to clarify or him?
Unfortunately, there isn't a capability here unless the student wants to submit an answer or a question again. If you want to clarify again in the Q&A section, please do so, and then um, I'll repeat
We
the
can,
question.
yeah,
Yeah,
we can head
that's
back.
our question for sure. Okay. And then let's see. A student is asking, is it smart to invest as an international student who might not stay in the US? If so, where would you start?
I think so. I think it's start to get familiar with investing at a young age, not even just investing, I think personal finance at a young age, really understanding how much you're spending, how much you're saving, how much you're making. And that can start at any age. I regularly talk to my nieces about this, and like they're turning 9. And as long as you get the concept in them where it's like, okay, well, spend if I if you eat all of your candy, I'm not giving you more candy. You'll have spent it all. And unless you want more candy, then you're gonna have to work for it, which is some type of money, at least to her world.
Yeah, and another question is, how do you decide to allocate the equity, bond, maybe cryptocurrency? What is a good strategy to allocate those investments to hedge risks?
Yeah. So again, that goes back to your risk tolerance, the basket of assets that you're working with. What's your time horizon? Where is that mental bucket for you? Is it the short-term needs where you want to use it in 3 years, 5 years? Is it the 5 to 10 years, or is it 10 and above? So once you have that cemented down, if this is something that you eventually want to retire with, then your time horizon is going to be 20 plus years. That means your ability to take on risk is going to be higher. And then you really have to dig further into, all right, how do I feel about taking on risk? And I take on as much as I assume that I can. And then that will help you determine which bucket you're in terms of, am I more conservative? Am I moderately conservative? Am I balanced, moderately aggressive, or am I aggressive? And then for things like crypto, because that sector is so volatile, I would advise caution on it, which in essence means that don't put your life savings in crypto.
Great advice. So I believe an alumni is asking this. If we want to be tax conscious, which investment vehicle should we prioritize?
If you want to be tax conscious, and you're really thinking about across I think at this point you're looking at the different accounts, which is why I mentioned everyone should open up a retirement account, because for retirement accounts, that's tax deferred growth. And that is the most tax efficient way of investing if you haven't already opened it.
Great. And then, do you have any favorite financial podcast or financial resources that could help us continue learning or educate us on what to invest in?
Of course. Anyone can reach out to me and I can add you to our weekly newsletter. I'm happy to do that. Or I listen to Bloomberg all day. I don't know if anyone wants to listen to Bloomberg all day, but Bloomberg, I think, is a really great resource. Wall Street Journal is a really great resource. Um, but I'm also happy to add you to the weekly newsletter, because maybe you don't want to listen to Bloomberg all day. I get that. Sometimes I get annoyed by Bloomberg too.
Yeah. So yeah, you can reach out to Mimi after our sessions here. So as a beginner in investing in stocks, what is a recommended number of different companies to begin with?
Number of recommended in researching. If we're researching, I would research an entire sector first. So whether, for example, if you want to focus on finance, maybe pick the top 4 or 5 banks and then read up on their annual reports, see the trends of their stock price, their earnings, any of the metrics that you really want to evaluate them on, just so you can understand not only those companies, but also the sector as a whole.
Mhm. And then any specific platforms that you suggest for average investors to get involved in when buying like ETFs, mutual funds, etc.?
I've tried a few independent brokerages before, where it's self-directed. So for example, maybe if you bank with, let's say, Chase, and they have a self-directed account, that's one way to use it. Or if you have like a E-Trade account, um, at Rockefeller, we do that as well, but the majority of the assets that we hold here are managed by a team.
Thank you. And then a follow-up question to how to contact you. A student's asking, what is the best way to contact you? Via email, LinkedIn, social media? How should students get in touch?
LinkedIn is a great avenue. I would say LinkedIn and email. And Sarah, if you want to share email, then obviously feel free to.
Awesome. Okay. I will send that out to you all after the session. But yes, you can look up Mimi via LinkedIn. Okay. Any advice for older individuals and student debt trying to make a plan for the future?
Mm, I think, like we mentioned, or like I talked about before, which is you want to do savings and investing at the same time, as well as paying down that debt, and really taking a look at budgeting. What am I spending on right now that's taking up the chunk of my expenses? I think it's so easy, and quite frankly, it's not really taught in elementary school, where we never really learn about budgets, but really thinking about, okay, what are my fixed expenses? What are my variable expenses? what do I need to absolutely put a roof over my head and food on the table? And what do I need as, entertainment? Do I really need to go to that concert? Do I really need to go to Coachella? Maybe, maybe not. But really thinking about, I'm not saying don't ever have fun. No one wants that. But really allocating, okay, we'll have a budget for fun. If I go over it this month, then maybe we cut back a little bit next month. And really just taking a comprehensive look at your budget. And then from that, start paying down the debt as well as building an emergency fund and investing.
Great, thank you. And then we have time for a couple more questions. So would you recommend a Roth or traditional 401k for retirement account?
That one is dependent on your income level. It's not as quick of an easy answer. There are income thresholds that, the benefit of Roth is that you pay the tax upfront, and for the traditional IRA, you pay with pre-tax dollars, and it's more income level dependent.
Great, thank you. All right, I believe that concludes our Q&A for the day. There was a question on sustainability and impact investing, but we will cover that during our third session.
On Thursday, if you
Thursday.
join on Thursday, we will be talking about them.
So stay tuned.
Thanks for joining, everyone.
And then go ahead and share my screen really quickly. Oops, sorry about that. I do want to make a quick announcement before you all head out. So as stated, we have several investing sessions still remaining. So Mimi will be doing Investing 201 from 5 to 6 tomorrow. And then also tomorrow we'll have our Understanding Taxes session and First Time Homebuyer session. And then day 4, we will talk about salary negotiation. And so we have our Know Your Rights and Know Your Worth session. And then we'll close off with 4 additional sessions, making the most of your workplace benefits. That will be at HSC. Mastering your credit score, sustainability and impact investing, and side hustles. All 3 of those will be via Zoom. So again, stay tuned. And lastly, please fill out our post-session survey. You can scan this QR code, and once you fill out this survey, you'll be entered into an opportunity drawing for a $50 Amazon gift card or Apple AirPods. If you have any questions about the conference, please email careers@usc.edu or myself at sarah.o@usc.edu. Thank you for tuning in, and we always end with fight on. Thank you, everybody.